The 3 Golden Rules to Real Estate Investing, 2021. Many gather true wealth using real estate. Most averagely rich people use this method to gain actual money without much effort. It is one way to perform good business, and for this, you require skills such as being an excellent analyst who knows a good deal when they see one. The same goes for knowing how to crunch numbers and find any faults at one glance. But not everyone can do that now, can they? So here are a few quick thumb rules that will let you analyze a deal properly. These rules were made by experienced investors and do not require too much brainstorming from your side. If there is a house that passes these rules, you will immediately know the potential they hold. Before we move forward, let me know if you are an experienced investor or not, and if the rules that will be presented are some that will help common people like you and me down below. Let us move forward with the video. Rule number 1, the 1% rule. This rule states that you consider the rental income you will expect every month, which is divided by the total value of the house after all of its repairs have come in line. If the above calculation results in a number over 1 or even 1, you know that you have a great deal at hand. If the result is below 1 and a lot below 1, the investment you are looking at is not the best one out there. But let us not stick to this. The truth is that sometimes even if the house would be in good demand, the location it is in might not need as many rentals as you may think. A city may have a section where most houses are owned instead of rented. This could be old couples or animals, and that is why they have such a section. But if you put it on a map, another section of the city will need a lot more rentals, since these places have temporary tenants. For example, places around universities and colleges are bound to have rental flats, since the students living here need a place to live for a few years only. So this results in a high ratio of rent to the value of the house. So this 1% rule will help you make a quick assumption regarding the place. It will help you understand if the property you are looking at will get you good deals or not within a couple of minutes. Let's take an example. If a house held a value of $100,000, the result using the 1% rule would be about $1,000, which is the monthly rent you can expect each month. But here is something that you should know. In the current market, you would find it difficult to find a house that meets the 1% rule correctly on the MLS. But that does not change the fact that it helps you determine a benchmark for judging properties and their values. Say you find a property that does not rent for 1% of the value, but about 0.09% or 0.08% of the total value of the property. Now that might still turn out to be an excellent deal for you to pay attention to. So, to say the least, the closer the result of the calculation is to 1% of the property value, the better. There is another similar rule, named the 2% rule, that requires you to do the same calculations, but the 1% just becomes 2%. The rules like these are to give us an estimated flow of cash when it comes to rental property. Let us take the above example. 1% of $100,000 is $1,000. Well, 2% of that would be $2,000. If you own a large property whose value goes around $500,000, you need to use the 2% rule instead of the 1% rule. This is because the higher the value, the higher should be the percentage to give you justice when it comes to this. Before we move on to the next rule, show us some love by hitting the like button and share the video with any friends that might find this video useful. Rule number 2, the 50% rule. This rule states that about 50% of the income gathered from rental properties goes into the expenses there are for operating it. These expenses consist of everything except the mortgage. They will be taxes, repairs, insurance, etc. The rule tells us that around 50% of the total income you get through rental properties is bound to be spent on operating expenses. This is the equivalent of saying that all you will have is about 50% of a month's rent you will collect. Now, this money will be used for paying the mortgage and will be considered as the profit if you make any. For instance, you have rented a flat for $2,000 per month. $1,000 is to go into any operating payments. Let us consider that if you want to make around the $100 profit every month from the same property, the amount of mortgage you will require to pay must be around $900 or less per month. The number you get will be your base for determining the maximum amount of purchase price for the property you are looking to purchase. Now, the 50% rule is to help you make an estimated judgment. So, if the entire calculation results in a nearby number to the 50% criteria, you are to crunch the numbers a little and go in deeper to get a clearer view. When you have reached this point, it is suggested that you check out the actual tax fares for the property. Make a call to your insurance company and check on how much they are ready to cover. Find out the age of the property, that is, how old is it. This will help you determine any additional costs and the maintenance cost you will have to cover each month. You could also contact a lender and find out about the actual interest rates at the moment. If a property comes close to the 50% rule criteria, you get an idea that you can surely invest your time and money along with your efforts into the property. This should give you the green signal to go ahead and analyze the deal further and give a try to crunch the numbers and dig a little deeper. The first two rules we looked at were largely focused on finding properties that can be rented. But the next one we'll be looking at is a lot more focused on purchasing a fix and flip. Rule number 3, the 70% rule. The maximum buying price of a property should not exceed the number you get when you consider the 70% of the value of the property after repairs minus the cost of repairs. This is an estimation. Say you think that a house is going to sell for about $500,000 after you give it a good fix. The 70% of that would be $350,000. You subtract your repair cost, which we can assume to be $70,000. This means that the maximum price you can get for the purchase is only $280,000. So this rule says that about 30% of your total value of the house is going to go straight into the operating costs. Now, these expenses can be anything, such as cost on the closing when you are at the end of buying the property, selling the house to the commissions of a real estate agent, the cost you need to cover when holding the property while you indulge it in renovations, utilities, taxes, etc. So, when you bring all of those expenses together, you require only two rough figures that will help you determine if the deal you have found for yourself is good or not. The number you get is the estimated value you can make your sale for once you are done with all of your repairs. It also helps you determine the cost you would bring onto yourself if you decide to fix the property up nice and clean. Now, the 70% rule is not always right, so it cannot be as accurate as the rest of the rules we looked at today. The rule fails to execute its task when the numbers fall in between extremes. Say if you are considering selling a property worth $1 million or $2 million, the rule does not work out all that well. Now, if the property you own has a value of $70,000 or $60,000, the rule does not exactly work out too well. The average cost of houses in the States is about $30,000, and anything up to $50,000 can work pretty well with the 70% rule. So, if there is a property worth around that range that passes the 70% rule, you can go ahead and crunch the numbers a little further. You can also find out if the operating expenses along with the holding costs add up to be the remaining 30% of the total value of the house after repairs or not. That is it for today, guys. Let us know if these rules help you or not in the comments below, and click on the subscribe button to unlock a lot of useful content. See you in the next video.